The Subcommittee on Financial Institutions will come to order. Without objection, the chair is authorized to declare a recess of the committee at any time. Today's hearing is titled Right-Sizing the U.S. Bank Capital Framework, a return to tailoring economic growth and competitiveness. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. I now recognize myself for 4 minutes for an opening statement. Today, this subcommittee turns its attention to an issue that sits at the heart of American economic strength, our bank capital framework. For years, Washington has layered rule upon rule on American banks, forcing them to retain capital at levels that far exceed standards applicable to our global competitors. And the results have been detrimental to U.S. firms. We have a capital system that is increasingly gold plates international requirements, imposes one-size-fits-all mandates on institutions with different risk and business profiles, and undermines the competitiveness of American institutions. Let me be clear. Republicans on this committee support a tailored, common-sense capital framework that protects the safety and soundness of the American financial system. But what we do not support is a regulatory framework that needlessly restricts credit, penalizes growth, and places American banks at a disadvantage against foreign competitors who are held to lesser standards. The Basel III Endgame framework should not be solely focused on international harmonization. It should be focused on economic growth as well. Capital should be right-sized to protect the economy, not inflated for ideological reasons, not used as a tool to achieve political objectives, and not calibrated without regard to the real-world impacts on lending, liquidity, and the economic vitality of local community institutions. This is why the Biden administration's initial Basel III Endgame proposal was deeply flawed and received bipartisan criticism. It threatened to elevate capital burdens so far above international norms that entire categories of banking business lines, from residential mortgages to market making, could have migrated to offshore institutions. Fortunately, the bipartisan message was clear. The Basel III Endgame must be reproposed, and that reproposal is not just an opportunity, but a responsibility to get this right. We need a framework that is proportional, tailored, and grounded in empirical analysis. We need a framework that recognizes the diversity of the American banking system. We must build upon the bipartisan S-2155 to ensure capital requirements are tailored based on a bank's size, complexity, and risk profile. Indeed, a regional bank focused on traditional lending should not be subject to the same standards intended for institutions engaged in significant trading, cross-border activities, or complex market operations. We must account for growth in the economy by indexing regulatory and category thresholds. This way, banks do not stifle their growth when it is needed most. If we get this right, if we right-size capital, eliminate unnecessary gold plating, and build a framework that tailors requirements to actual risk, we can preserve what makes American banking exceptional. We do not want a barbell banking system in this country with a number of small banks and GSIBs and nothing in between. Achieving this stems from a well-calibrated capital framework that incentivizes growth and competition while maintaining safety and soundness. We must ensure that community banks continue to serve as economic anchors in small towns and rural communities. We must keep U.S. institutions competitive on the global stage, and we must create a regulatory environment that supports, not strangles, growth, innovation, and opportunity. So today, I look forward to hearing from our witnesses about how we can design a capital framework that strengthens stability without sacrificing competitiveness, that respects the structure of the American banking system, that promotes the heterogeneity and diversity of that system, and reins in the excesses of prior regulatory overreach. I thank our witnesses for being here today to provide their valuable insights and perspectives, and I yield back. I now recognize the ranking member of the subcommittee, Dr. Foster, for 4 minutes for his opening statement.
Thank you, Chairman Barr, and to our witnesses. I represent Woodstock, Illinois, where the film Groundhog Day was filmed. So here we go. Now, we're going to once again examine the regulatory capital framework for U.S. banks. Part of the prudential regulatory umbrella, capital standards provide a buffer against insolvency when financial institutions take losses, helping them weather economic downturns, failed investments, or the missteps of management. The 2008 financial crisis highlighted flaws in the regulatory framework for U.S. banks when the true risk of assets did not match the corresponding capital charge assigned to them. Supposedly well-rated mortgage-backed securities and off-balance sheet exposures received little supervisory attention, leading to massive losses, and a crisis of confidence in the banking system when those same assets dropped by enormous amounts. In response to this crisis and the taxpayer-funded bailout of the U.S. financial system, Congress passed the Dodd-Frank Wall Street Reform and Consumer Protection Act to enhance the supervision and regulation of the financial system. Dodd-Frank took a tiered approach, applying the most stringent capital to the largest and most complex banks that posed the greatest risk to financial stability. The largest banks became subject to safeguards meant to prevent a similar crisis, including higher capital ratios, stress testing, resolution planning, and other prudential requirements. Following the financial crisis, financial regulators around the world, including the United States, convened in forums like the Basel Committee on Banking Supervision to facilitate cooperation between member countries and enhance financial stability. These forums are important as this cooperation prevents a race to the bottom that would ultimately make the global financial system much less safe. Since the enactment of Dodd-Frank, Congress has revisited several prudential standards to respond to changes in the banking economy. Risks to financial stability change over time, and new risks emerge, which, for example, everything having to do with technology that should be our focus today. And unfortunately, instead of repeating the same debate that's crystallized around 2009, hasn't changed in almost 15 years. And the regional banking crisis, for example, in 2023, demonstrated that bank runs following steep losses can occur much faster than previously thought, and they're going to become faster when agentic AI makes bank runs possible at the speed of AI rather than the speed of internet gossip. I worry that these type of events will be much more common with the commoditization of AI, the introduction of emerging volatile assets into the banking system. Banking regulators have a duty to ensure that the banks and their agencies are ready to deal with these types of runs and to strengthen safeguards against rapid withdrawals and dramatic price swings in various asset classes. Under President Trump, the banking regulators have taken steps that undermine this financial stability, namely by dismantling the Consumer Financial Protection Bureau, which was created by Dodd-Frank to stop the very same predatory lending practices that contributed to the global financial crisis. They've also moved to weaken stress testing for the largest banks, cut staffing at FSOC and its member agencies, and are pushing firms to engage with digital assets that can experience extremely high price volatility. We expect banking regulators will soon propose a revised rule to implement the principles of the Basel III Endgame. Under the last iteration of the proposal, members of this committee raised certain concerns about the proposal related to the capital treatment of mortgages, small business loans, tax equity, and derivatives used for risk management. So I encourage regulators to consider these concerns as they develop the new proposal and the combined impact to financial stability with the other changes being advanced on leverage, stress testing, and other areas. My colleagues on this committee should call for a robust cost-benefit analysis for the coming proposal, as they did with the last proposal, and push regulators to back up their proposals with data. Thank you again, Chair Barr, and I yield back.
The gentleman yields back. I now recognize the chairman of the full committee, Mr. Hill, for 1 minute for an opening statement.
Thank you, Chairman Barr. The U.S. banking system's at a pivotal juncture right now. Regulators have the opportunity to establish credit and capital standards that strengthen financial security without unduly limiting economic growth or banks' ability to compete on an international scale. Even so, small and community banks continue to face disproportionate compliance and capital burdens that were never intended for institutions of their size. Despite these challenges, U.S. banks remain, as Chairman Powell has mentioned many times, well-capitalized, resilient, and able to support lending, investment, and economic growth. This does not mean we should ignore the inefficiencies in the current framework. And particularly under Chairman Barr's leadership, the Congress must encourage regulators to tailor capital requirements based on bank size, complexity, and risk profile, rather than applying a one-size-fits-all approach. Thoughtful tailoring can free up capital for productive uses, helping banks support small businesses, home buyers, and economic expansion across all of our districts. Thank you, and I yield back.
I now recognize the ranking member of the full committee, Mrs. Waters, for a 1-minute opening statement.
Thank you very much. I look forward to the testimony as we discuss bank capital. Trump's regulators and Republicans are tearing down the safeguards that keep our banks safe to ensure stable economic growth. Reducing capital for our largest banks will make them less resilient, less likely to lend during periods of stress, and more likely to fail. Weakening these safeguards, these guardrails, leads hardworking Americans to bear the consequences. We saw this in 2008 when banks gambled with borrowed money and families, workers, and small businesses and whole communities paid the price. If we want to strengthen our financial system for the benefit of small businesses and their workers as well as community banks and credit unions, then I hope Chairman Hill will work with me to advance overdue deposit insurance reforms. And on this issue of capital and the continued efforts by the Republicans to reduce the capital that the bank should hold, we're going to have a fight.
Gentlelady's time has expired. Today, we welcome the testimony of some outstanding witnesses. First, Ms. Margaret Tahyar, Head of Financial Institutions at Davis Polk. Ms. Amanda Eversole, President and Chief Executive Officer of Financial Services Forum. Mr. Andrew Olmem, Managing Partner and Co-Leader of the Financial Services Group at Mayer Brown. Mr. Mike Flood, the other Mike Flood, Head of the Center for Capital Markets Competitiveness at the U.S. Chamber of Commerce, and Mr. Simon Johnson, Professor of Entrepreneurship at the MIT Sloan School of Management. We thank each of you for taking the time to be here. Each of you will be recognized for 5 minutes to give an oral presentation of your testimony. Without objection, your written statements will be made part of the record. Ms. Tahyar, you are now recognized for 5 minutes for your oral remarks.
Chairman Barr, Ranking Member Foster, and members of the subcommittee, thank you for asking me to testify. Capital regulation is long overdue for a rethink, and this subcommittee should encourage the banking regulators to move quickly to appropriately implement the Basel III Endgame with appropriate data, appropriate cost-benefit analysis. I'd like to leave you with 3 thoughts this morning. First, capital is very important, but it is not the only tool in the financial stability kit. Second, choices about the calibration of capital are political economy choices that involve credit engineering. They can also change the regulatory perimeter. Third, our economy and our banking sector are complex. Tailoring, as the chairman has noted, is the solution so that we do not treat large banks the same as community banks. Capital is an important thing, but it is not everything. We cannot expect it to be the sole insurance against financial stability. We should see it as part of an integrated system that also includes early intervention, resolution planning, credit concentration, contingency planning, risk management, TLAC, deposit insurance, and hands-on supervision. And we should understand that capital absorbs losses, but it's not liquidity regulation, so it doesn't help against quick deposit runs. Capital regulation involves political economy choices. How much financial stability insurance should a banking organization be required to purchase? Any increase in bank capital requirements increases the cost of funding. I think we can all agree that capital levels going into the great financial crisis were too low, but today I think we have to ask whether current capital levels also come at a cost to the real economy. Risk rating for purposes of risk-based capital requirements is a form of credit engineering. The 0% risk weighting for treasuries, the 50% risk weighting for mortgages, and the International Basel Committee's 1,250% risk weighting for crypto assets reflect political economy choices that are appropriate for this committee to oversee. For example, if implemented, the crypto assets risk weighting would seem to be contrary to the Genius Act. Another point is that any capital framework will need updating and renewal from time to time, even though the debates share patterns. That update should be data-driven, understanding it'll never be perfect. Markets and technology and geopolitics aren't waiting around for the Basel III Endgame. In fact, calling this latest round of rulemaking Basel III Endgame is kind of a misnomer, implying that once the next round of rules takes effect, we're done. And I think we should not think of capital as a Marvel movie with a tidy ending. The economy, the financial system will remain in constant flux, and banking regulators should periodically review capital regulation. Capital regulation should be tailored. The tailoring principle is especially critical in the United States, given the complexity of our economy, the largest economy in the world, the geographic spread. We have a banking sector whose structure is very different from most other countries with our many different sizes of banks, and we need to avoid that barbell. Wisely, the banking regulators did not impose every new complexity on every banking organization. But it is fair to question whether we're appropriately tailored and whether there should be some indexing, particularly for as the economy grows. All policy choices have trade-offs, but our focus should be on the real economy, jobs, American competitiveness, and wealth creation. This should not be a red team, blue team issue. We should approach it in a spirit of bipartisanship as a purple issue, and in that spirit, I am wearing a purple jacket today. Thank you. Thank you.
Thank you, very good. Ms. Eversole, you're now recognized for your testimony.
Great, thank you, Chairman Barr, Chairman Hill, Ranking Member Foster, and Ranking Member Waters, members of the subcommittee. My name is Amanda Eversole, and I'm President and CEO of the Financial Services Forum, which represents the 8 global systemically important banks, or GSIBs, headquartered in the United States. Every day, Forum members and their nearly 700,000 employees across this nation provide the capital that fuels America's economy. Forum members provide nearly half of all consumer lending by banks in the United States by helping Americans purchase their first homes, buy a family car, or start a business. Forum members also support our vibrant, highly liquid capital markets, ensuring that they remain the envy of the world. And Forum members play a critical role in meeting the funding needs of other financial institutions, including community and regional banks. Above all, we remain committed to ensuring a strong, stable, and healthy financial sector and economy. The U.S. GSIBs have never been more capitalized and more resilient. They are subject to the most stringent regulatory standards among both U.S. and foreign competitors. Over the past 15 years, the U.S. GSIBs have tripled their capital and now maintain more than $1 trillion in high-quality capital. But more capital isn't always better. There are economic trade-offs to higher requirements. According to academic research, a 3% increase in required capital cost can cost the U.S. economy between $100 and $150 billion per year. And it's critical that we get the balance right. After years of post-crisis implementation, now is the time to modernize large bank capital regimes so U.S. banks can better support American families, small businesses, and our capital markets. We appreciate efforts by the administration and regulators to take a comprehensive approach to capital. There are 3 important factors that should be considered as this committee explores this issue further. First, capital requirements must be supported by data and calibrated accordingly. The Basel III Endgame proposal from 2023 serves as a prime example. That proposal and the regulatory approach to the Basel III Endgame would have increased capital for foreign members by 25% without any clear justification or analysis. More than 97% of commenters raised concerns with the proposals, and 86% of those comments came from outside of the banking industry, which is an important fact to note. Capital rules have a clear and significant impact on homeowners, small businesses, retirees, manufacturers, and farmers. It's critical that we take the economic impacts into consideration when determining capital rules, and we look forward to the revised Basel III Endgame proposal that meets the needs of the U.S. economy. Second, several aspects of the large bank capital framework make it harder for U.S. banks to compete, pushing activity to foreign banks and less regulated non-banks. This migration of risk makes the system less safe and less stable. The GSIB surcharge is perhaps the best example of a self-inflicted disadvantage with our foreign competitors. The U.S. approach to the GSIB surcharge is nearly twice that of our foreign competitors, resulting in an additional $100 billion in capital that could be deployed into the U.S. economy. We appreciate the commitment by regulators to review this rule, and we look forward to a proposal that will harmonize the U.S. GSIB surcharge with the international standard to better meet the needs of U.S. business and hardworking American families. Third, enhanced transparency and public accountability is the bedrock principle of good government. The Federal Reserve's initiative to improve the transparency of stress testing models and scenarios will improve bank risk management, reduce volatility, and allow banks to better serve their clients and customers. We look forward to providing our comments in this proposal. The world has changed over the last 15 years, and regulations haven't kept pace. Thankfully, regulators have begun to address this problem by recalibrating the enhanced supplementary leverage ratio, a move that will enable banks to intermediate the U.S. Treasury market without sacrificing overall financial stability. We look forward to continued progress in this important area. Now is the time to modernize capital requirements so we can unleash our full economic potential, boost lending to small businesses and consumers, and drive America's economy forward. Of course, we can do that while protecting the safety and soundness of the best financial system in the world. Thank you for the opportunity to testify today, and I look forward to your questions.
Thank you. Mr. Olmem, you're now recognized.
Chairman Barr, Ranking Member Foster, Ranking Member Waters, and the members of the subcommittee. I appreciate the opportunity to testify today on right-sizing U.S. bank capital framework. My testimony is given in my personal capacity and not on behalf of Mayor Brown or any of his clients. I want to start by commending the subcommittee for holding this hearing because capital requirements are at the core of effective bank regulation. They have a major impact on the safety and soundness of the banking system, as well as on the overall economy in each American household. It is therefore critical that they are appropriately calibrated. This committee's oversight of the prior Basel III Endgame proposal played a valuable role in raising bipartisan concerns about its potential adverse consequences. Those concerns prompted the banking regulators to pause and reconsider the proposal. Thanks to this committee's work, the Basel Endgame is moving in a better direction. As the subcommittee now prepares to evaluate the upcoming revised Basel III Endgame proposal, I've included in my written testimony several recommendations for your consideration. I concur with the prior remarks of my panelists about the importance of basing capital requirements on the best data and research available, and that choices about capital requirements are public policy choices. I'd like to highlight 3 additional points from my written testimony. First, it is important to view any capital proposal within the context of the larger regulatory reforms the banking regulators are currently undertaking. The most important, in my view, of these is the ongoing reform of bank supervision. Effective supervision is an essential companion to capital requirements because supervisors can identify and address risks that do not show up on balance sheets. Unfortunately, bank supervision has become far too bureaucratic, with supervisory matters lingering for years unresolved. Supervision should be focused on identifying problematic and material risks, addressing them, and returning a bank to normal operations. Reforming bank supervision will facilitate better compliance with bank capital requirements, as well as faster resolution of problems with bank capital and other safety and soundness matters. The banking regulators' efforts to reform bank supervision should have Congress's full support. Second, one-size-fits-all regulation can undermine competition and the ability of banks to devise unique business models to serve their communities and customers. As noted, to address this problem, Congress has statutorily mandated in both the Dodd-Frank Act and in the Economic Growth, Regulatory Reform, and Consumer Protection Act, known as S-125, that the banking regulators tailor enhanced prudential regulation. This mandate sensibly seeks to prevent a $300 billion bank from being regulated in the same manner as a $2, $3, or $4 trillion bank. However, changes in the marketplace and inflation can push banks in inappropriate tailoring categories. Given the clear congressional mandate, the banking regulators have reasonable grounds for revising and updating the existing tailoring categories. Finally, it's important to consider the vital national interest at stake in ensuring that the U.S. has the world's safest, most sophisticated, and technologically advanced financial regulatory system. The U.S. benefits greatly by being the world's financial capital, where all major financial institutions want to participate and invest. These benefits include lower financing costs for not only U.S. consumers and businesses, but also for the federal government's now $38 trillion debt. Furthermore, the dynamic $30 trillion U.S. economy requires an equally dynamic financial system that can fund the remarkably diverse and complex needs of consumers and businesses. Unfortunately, U.S. bank regulation has diminished the attractiveness of the U.S. market and made the banking system less innovative and less adaptable. These trends need to be corrected. Otherwise, Americans will face higher costs of living in the short run and will build wealth at a slower pace in the long run. The finalization of the Basel Endgame proposal, updating the tailoring thresholds, and reforming bank supervision are important steps for modernizing U.S. bank regulation and ensuring that the U.S. has the banking system it needs to see the economy thrive and American households' living standards rise. Thank you.
Thank you. Mr. Flood, you're now recognized for 5 minutes.
Good morning. Chairman Barr, Ranking Member Foster, Ranking Member Waters, members of the subcommittee, thank you for the opportunity to testify on right-sizing the U.S. bank capital framework. My name is clearly the other Mike Flood. With over 27 years of experience in financial services industry, I'm honored to represent the U.S. Chamber of Commerce, the world's largest business association representing businesses of all sizes. Capital decisions affect every consumer and business in your district, whether they're a first-time homebuyer, a local tailor, or a new business. Since the release of the previous Basel III Endgame proposal in 2023, both parties in Congress, numerous state and local governments, industry, and bank customers have all raised significant concerns. In reaction, the previous Fed Reserve Vice Chair Barr recognized that not only raising capital, but raising it beyond global standards should be recalibrated. We applaud the current leaders of prudential regulators for continuing this process, including updating the enhanced supplementary leverage ratio and reforming the stress testing framework. We thank the members of this committee also for your continued oversight and engagement. There are 3 reasons why businesses care about capital. First, banks supply the substantial majority of small business financing. Last year, banks provided 9.1 million small business loans, of which the G-SIBs comprised 25%. 2, increased capital increases costs or reduces credit availability. A chamber survey of over 300 treasurers, not 300 bank treasurers, 300 treasurers, makes clear that capital increases are felt by businesses and consumers. It found that 87% of businesses have been negatively affected by financial regulation, and more importantly, 40% have decreased services to their customers. Furthermore, a Basel study stated that for every 1% increase in capital, we should expect a 13 basis point increase in loan spreads. Think about that if we were to increase capital by 20%. Furthermore, the Basel Committee itself said higher capital and liquidity requirements are assumed to increase the cost of bank credit. 3, more capital is unnecessary. Results and statements from the regulators themselves do not support increasing capital. First, in the past 3 stress tests reveal that banks can withstand, quote, a substantial downturn, remain above minimal capital requirements, and lend to the U.S. economy. 2, bank capital has more than tripled since 2009, and let's not forget that COVID was a real-life stress test. And if you don't believe me, let's believe the results from the FDIC. Over the past 5 years, 11 banks have failed, equal to a 0.052% failure rate. At the same time, bank charters have decreased by 3% annually, with a mere 45 new charters granted. So what's the impact on your constituents? I'm going to give you a few examples of the Chamber's analysis of the previous proposal found. 1, private companies will pay more than public companies if we have excessive capital. Despite that 99% of U.S. companies are private companies, they are seen by Basel III Endgame as more risky than public companies. Quite frankly, it's hard to imagine outside of taste how Five Guys, a private company, and Shake Shack, a public company, are different. 2, lines of credit under Basel III Endgame would be more expensive. This is the monthly lifeblood of nearly any business. Your local tailor will pay more for the used line of credit and, oddly, pay more for the unused line of credit. And again, this is beyond global standards. 3, mortgages, credit cards, and automotives will cost more, especially for constituents with low credit scores, and individuals with low and moderate incomes will be most affected. In conclusion, at a time of significant affordability concerns, it is critically important to calibrate the entire bank capital structure to fit the size and complexity of the U.S. banking system. This does include all banks, local, community, regional, super-regional, national, international, and global banks. The Chamber appreciates the current regulatory efforts to update the capital framework and bring supervision back to materiality. We therefore urge regulators to adopt the following recommendations. Calibrate any final rule to preserve affordable lending, market-making liquidity, and a competitive U.S. banking system. 2, base requirements on robust economic analysis that considers the impact on lending and economic growth. And 3, update and tailor capital requirements as well as thresholds to reflect the size and risk profile of individual institutions for all categories of banks. Thank you, and I look forward to answering your questions.
Thank you. And finally, Mr. Johnson, you're recognized.
Thank you. Chairman Barr, Ranking Member Foster, members of the subcommittee, thank you for asking me to testify at this timely and important hearing. My name is Simon Johnson. I'm a professor at MIT. I was previously the chief economist at the International Monetary Fund. I'm a former board member at Fannie Mae. I'm currently co-chair of the CFA Institute Systemic Risk Council. I would like to make 3 points. The first is about the numbers. Tier 1 capital, as you know, is the strongest form of capital because it is fully loss-absorbing. This includes shareholders' equity and retained earnings. The supplementary leverage ratio, SLR, calculates the amount of Tier 1 capital in 13 large banks relative to their total leverage exposure, which includes total assets and certain off-balance sheet items such as derivatives and loan commitments. The weighted average SLR for the 8 American globally systemically important banks, the G-SIBs, peaked at close to 7% in 2017, and it's now 5.8%. That's an increase in leverage. This is all from their publicly available data as compiled by the Kansas City Fed. European and Canadian G-SIBs are more leveraged, with an average SLR at 4.89%. Now, this is exactly the same relative situation as prevailed before the global financial crisis of 2008. The biggest European banks are more leveraged than the biggest US banks. But when a crisis breaks, more leverage means more vulnerability for individual banks and the financial system. Thank goodness that the FDIC pre-2008 resisted attempts to allow more leverage in the US banking system. By insisting on lower leverage, the FDIC under Sheila Bair helped protect the taxpayer, limit the fiscal damage, and reduce the number of jobs lost when the crisis hit. It is not, and I repeat, not, to the European advantage that their big banks are more leveraged. That is a major vulnerability for them, exposing their taxpayers and their workers and their non-financial businesses to more risk. Do not race the Europeans to the bottom. Second, unfortunately, the FDIC today is in the exact opposite position to what it was before 2008 and just signed off, along with the Federal Reserve and the OCC, on reducing the SLR. Now, based on the regulator's own calculations, this recent rule change will allow the SLR, so again, setting the maximum leverage for big banks, to reach around 3.8% for those 13 mega banks. And we're now discussing how to adjust risk-weighted capital and stress tests and other things will allow the banks to move closer to that leverage. The regulators have clearly signaled that we are heading back towards the leverage ratios that prevailed before the crisis of 2008. And we're doing this without a proper cost-benefit analysis, without any kind of robust economic analysis. What we need is a careful and complete study from the regulators of what will happen to the system stability with lower capital requirements. They have not provided this despite repeated requests from responsible parties. Third, the arrival of artificial intelligence is a game changer for finance, as was discussed and emphasized at the House Financial Services Committee hearing yesterday. One presumed impact is that decision-making will speed up globally. AI agents will rush into trades, pushing up asset prices. These same algorithms will also rush out, creating various kinds of potential runs and fire sales. We are quite likely to experience, as Dr. Foster said, various forms of AI agentic runs on our banks. What happened to Silicon Valley Bank will seem slow by comparison. Bank capital protects against insolvency. This is the loss-absorbing buffer. If the world is becoming more unstable, we should want our big banks to have more loss-absorbing capital. Instead, the regulators are pushing in a reckless manner towards allowing less capital. In summary, capital at the largest banks is eroding. This undermines our system and our economy. It makes us weaker in the global economy. In 2008, we barely had enough capital in our biggest banks. Since 2008, the world has become more unstable. Pandemic, global financial crisis, rise of China, AI. The the U.S. economy needs a resilient banking system. The regulators are failing you and failing the American people when they allow leverage to rise to pre-2008 levels. And finally, I would like to quote from the National Security Strategy just released by the White House. Quote starts, "We want a resilient national infrastructure that can withstand natural disasters, resist and thwart foreign threats, and prevent or mitigate any events that might harm the American people or disrupt the American economy. No adversary or danger should be able to hold America at risk," end quote. To achieve this goal, as stated in this document, you need more loss-absorbing equity capital in the banking system, not less. Thank you very much.
Thank you, Mr. Johnson. We're now going to turn to member questions. I now recognize myself for 5 minutes for questioning. Ms. Eversole, the word of the day in Washington is affordability and making life easier for the American people by lowering the cost of living. How can regulatory tailoring and enhancing U.S. bank competitiveness through right-sizing the capital framework lower the cost of capital and help lower the cost of living for Americans?
Mr. Chairman, thank you very much. Affordability is a huge issue. And I think when it relates to bank capital, one size doesn't fit all. And so we have a sophisticated system, in fact, the best, most highly liquid, vibrant capital markets in the world, and we have the ability to make sure that we get it right. And I appreciate the fact that this hearing has happened today. The Basel III Endgame, making sure we get that right is a perfect example. If we can get that done, the impacts go to small businesses, Main Street, through lower cost of borrowing, and that helps drive the economy.
Getting this wrong and over-regulation of the banking sector will drive up the cost of credit, period. That is a simple and absolutely true fact, and that's why we've got to get this right. Mr. Flood, miscalibrated capital rules are extremely burdensome on small institutions that keep credit flowing to Main Street America. Community and regional banks are often the only lenders serving rural towns, family farms, small manufacturers, and first-time homebuyers. What are the downstream effects of inflated risk weights under the Biden administration's Basel III Endgame that would affect community and regional banks' ability to provide mortgages, agricultural loans, and small business credit?
Thank you for the question. Ms. Barr, when we surveyed those 300 corporate treasurers, we found that most small businesses use banks for their financing. They use an average of 4 banks. And I think you can see from our analysis the amount of banks in the country is decreasing. So the simple answer is, A, your constituents will either see increased costs or lack of availability of credit at banks. Third, we also know that increased compliance costs affect every bank. And we've seen how that has led to consolidation at the lowest levels. And finally, community banks like to replenish their capital. How do they do that? They sell loans or products to bigger banks. If those bigger banks have increased costs or increased risk weights for those same products, they're going to charge more to your smaller bank. So there's a downstream effect.
Yeah, this is trickle-down regulation. It's not just about the big banks, it's about community banks and making sure that the capital framework does not inadvertently shrink access to credit in underserved markets. Ms. Tahyar, in 2023, when the Vice Chair Barr, the other Barr, proposed the Basel III Endgame, it received bipartisan and nearly universal criticism from lawmakers and the public. In fact, more than 97% of the comments on the proposal were negative, with more than 80% of those comments submitted by interested parties outside of the banking sector. The message was clear that we needed a reproposed endgame. But even under the reproposed endgame, the expectation is that U.S. banks will face materially higher risk-weighted assets from revised credit, market, and operational risk frameworks. Yet the leverage ratio remains unchanged, which creates a potential for double counting of capital requirements. How should regulators appropriately account for reforms to Basel III Endgame to ensure that bank leverage ratios do not bind institutions during low-risk, high-liquidity environments?
Double counting is a real issue, Chairman Barr, and I'm glad you asked the question. I think what happened in 2023 is that the banking regulators did not do a bottoms-up data-driven analysis. And currently, it's a bottom-up data-driven analysis that is being promised by the banking regulators. The leverage ratio became the binding constraint as Treasury markets expanded, given the fiscal situation. And my own view is that there should be a real rethink of the leverage ratio, which affects, as you know, not just the biggest banks, but all of the banks.
Thank you. Mr. Olmem, final question. As you know, Fed Vice Chair of Supervision Michelle Bowman has said that the regulatory thresholds should not be static, and FDIC Acting Chair Travis Hill recently finalized a rule that seeks to index regulatory thresholds on a biennial basis. I have introduced legislation, the TIER Act, to ensure that our regulatory system isn't static and that it's designed with growth in mind, which while maintaining safety and soundness. Can you please speak to the importance of indexing regulatory thresholds and how this will help ensure banks are holding appropriate capital that accurately corresponds with their size, risk, and scope of activities?
Thank you for that question, Mr. Chairman Barr. Put simply, if we don't index the thresholds, eventually we won't have tailoring, because over time, inflation will move institutions into higher and higher categories. Already since 2019, when the categories were adopted, we've seen inflation run at about 25%. Nominal GDP is up 30%. That already is threatening to put institutions into higher categories simply because of nominal changes in the economy.
Thank you. My time has expired, but I'll just note for the record that when Dr. Foster and I traveled to Basel, Switzerland, it was interesting to hear the Basel Committee themselves say that former Vice Chair Barr's proposal had gold-plated American capital requirements over and above what they recommended. With that, I will now recognize the ranking member of the subcommittee, Dr. Foster, for 5 minutes for questions.
Yeah, well, thank you, and thank you for referring to our bipartisan trip to visit all the banking centers. It was interesting because there was a lot of anxiety in the European banking sector that despite their lower capital requirements, they were being outcompeted by the big banks of the United States. So that the argument, I think one of the witnesses here referred to it as a trope that the regulators that should look at the fact that we're actually increasing market share with our giant banks compared to our offshore competitors as something that maybe the regulators shouldn't look at. I think if we're losing market share, the regulators should look at it, and the fact that we're increasing market share, the regulators should consider in whether our capital requirements are too stringent. But my biggest worry about this is that we're arguing about the last few basis points of capital requirements when the big elephant in the room is artificial intelligence, agentic AI, and everything that is going to disrupt financial services and the businesses that many banks have loaned money to. And this is something I was very disappointed that we had. There was I think Ms. Eversole's. That's when she made reference to the commentators on this. You can't open any financial journal or anything without seeing people comment on the bursting of the AI bubble, and are we really robust against that? There is probably no commentator that hasn't opined on that. And yet, when we recently wrote a letter to FSOC to say, hey, could you please have a look at this? We were unable, frankly, to get any of my Republican colleagues to co-sign this, and all of the Democrats essentially signed on to it. And so I think this is why we created FSOC, to look around the corner. Mr. Johnson, you actually mentioned this in your testimony. Could you say a little bit more about what AI could do to the stability of our financial system?
Yes, I think, Dr. Foster, you're totally right. This is the big issue of the day and of the days to come. We don't know, nobody knows exactly what will be the impact of AI on the American economy or on the financial system, but it does seem very likely that it will increase volatility. There'll be relatively few foundation models, there'll be relatively few big tech players producing those models. Everyone will be using some version, some application of those models, so there'll be a lot of crowding in terms of spotting opportunity and crowding in, so we may well get more run-ups in asset prices, but also crowding on the way out. So you referred to the run from Silicon Valley Bank, which of course we know was speeded up by social media. No AI was involved. AI can make decisions much faster than humans can. So once they spot a weakness or a perceived potential insolvency because of capital deficiency, it'll be seconds, not minutes, before the deposits run out the door.
Yeah, and well, in fact, they can respond to rumors. Many of the personal AI agents will be under standing orders that if you read a rumor out on Reddit that your bank's in trouble, get my money the heck out. And it will be, things like customer loyalty will be a thing of the past. And this is not only going to affect banks, it will affect every business that depends on customer loyalty, because the personal agents are not going to be loyal. They're going to be instructed to get the best price. And this is going to squeeze the profit margin out of every consumer-facing business in the country. And there are going to be a lot of loans that will go bad because business models will blow up that way. And so, this is not the time to lower capital requirements. You know, this is, I'm in my bipartisan way, I'm also wearing a red pin here. This is the red pin of the 110th Congress, where under a Republican president and under a Republican regulators, this pin had the pleasure of voting for TARP under a situation where the Republicans who voted for the lower capital requirements and deregulation refused to provide the votes to rescue our economy, and rescuing our economy had to be done with Democratic votes. And so, you know, this is a foundational memory in many of us on this side of the aisle who lived through that. And you know, we don't repeat history, but it echoes. We're in a situation when we have a historically unpopular president once again, and regulators who have this mantra of deregulate, 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 modernize. You know, all of the words you can read in 2007, the exact same mantra. And so, you know, there are things that make sense that we have to do. You know, punishing bank capital because they're holding treasuries, you know, I never thought made sense, and that's the sort of thing we could be looking at. But the idea of just lowering capital requirements in general right now, until we understand the effect, I think is premature. So I'd like to thank you all for your testimony. It's nice to see that the arguments haven't changed in 15 years, but the future is coming at us fast, and we should look forward, not backward. Thank you.
The gentleman from Michigan, Mr. Huizinga, is now recognized.
Thank you, Chairman Barr. And good to see our panel again, or most of you, and welcome, Mrs. Eversole. Mr. Flood, I'm going to start with you. A lot of discussion this morning has been centering around how higher capital requirements for financial institutions will be harmful. Obviously, not everybody agrees with that on the panel, but I happen to agree with that sentiment that it is or can be harmful. What's often overlooked, though, and from my perspective, is Main Street America. And that's really what I'm concerned about. You know, those small businesses that are the backbone of local communities that we all represent. I'm a small business owner myself, families in construction. I've lived through the ups and the downs are tough. And we've had to rely on lines of credit. Recently actually ended my own line of credit because it was costing me while I wasn't actually accessing it. My business partner, my cousin, and I looked at each other and were like, well, this makes zero sense. We've got a lot of issues, as you can see, as it pertains to small businesses. But yeah, just give us your thoughts on how this affects maybe Main Street and those small entrepreneurial, or in my case, a third-generation family business.
Sure, and I imagine your business was a private business.
Yes, Huizinga Gravel is not a publicly traded company, thank goodness, and I have no intention of subjecting ourselves to the SEC. So.
Well, that puts you at 99% of U.S. companies.
Yeah.
And I'll give you 3 concrete examples. The first one was the line of credit, and you've clearly experienced that. What surprised me is the risk weighting for both the funded and unfunded increase. There's no reasoning why, and it goes above gold-plated levels. So you've just said what happens. One, your line of credit either gets more expensive or they shrink it. So if you need more money, you'd have to go get another one, and I'm sure they'd see that as more risky.
Not to mention, by the way, when the regulators come in and say, oh, by the way, even though we've been banking with the same bank for 3 generations, we're not sure of their credit risk.
Correct. And simply because you're a private company, as an example of excessive capital, Basel III Endgame treats you differently. And let's assume that a public company has an interest rate of 7%, and let's presume a 12% return on capital. That same private company is going to have a 10.5% interest rate. That's how different it is. Then there's the third part, which is I want to bring up something called risk mitigation. It's exactly what it sounds like. And we mix that up with derivatives a lot. So now let's think about a farmer who wants to mitigate their crop because they've seen climate issues. So they go to the bank and they say, hey, I want to buy a hedge from you. And the bank should say, that's great. That makes you less risky to me and me less risky to you. But somehow, oddly, we've priced that higher. So the hardest thing for our businesses to understand is...
So lowering risk is actually going to cost me more than if I had just maintained the status quo.
Those are some of the confounding things in the regs that we have.
Okay. Mrs. Eversole, I want to touch base on you. You represent the largest of the banks. Does the current framework disadvantage U.S.-based institutions compared to their international peers?
Thank you very much, Congressman, for the question. Indeed, it does. The fact of the matter is, even if you look at something like the GSIB surcharge, we are twice that of our international competitors. And I think that we are at a
But we just heard that that's necessary, and that maybe we don't have enough capital.
Yeah, respectfully, I would disagree with that premise, and I think it's a perfectly appropriate conversation to ask the question: is more always better? And to your earlier question, it's not free. It comes at a cost, and the cost is borne by consumers, the very people that need these.
It's not the banks.
I think from a consumer perspective, you can see the cost of credit is increased by higher capital.
Mrs. Tahyar, let me switch slightly on this. What are the macro effects on the economy of this one-size-fits-all approach?
Well, I think what it's doing is it is leaning us towards the dreaded barbell. I think the statement was made that our biggest banks are more competitive than the EU banks. That is clearly right. They're out competing. But if we look at the mid-size range banks, say from 10 up to about 250 or more, they and the community banks are the engines of growth for small and medium-sized enterprises, for religious entities, for NGOs in smaller towns. And the macro impact on them, and then we're now at a place where we want to have a lot of more credit in the heartland of the country, Michigan, where you and I are both from. And that's going to be hard to get if we insist on gold plating of capital standards.
And Mr. Chairman, I'm just afraid that we're losing the other end of that barbell with the smaller community banks and those regional banks. So with that, I yield back.
Gentleman yields. The gentlewoman from California, Ms. Waters, is now recognized.
Thank you very much. Professor Johnson, while Republicans may want to roll back capital requirements, I think there is a much more important and bipartisan policy that Congress should consider. In 2023, after Silicon Valley Bank had the fastest bank run in the United States history, many businesses got nervous about their payroll accounts being held by smaller banks and moved their funds to the mega banks, thinking they were too big to fail. A year later, a much smaller bank in Oklahoma failed as well. But their failure was too small for regulators to use emergency tools to protect depositors. The failure resulted in small businesses, churches, other customers with more than $250,000 to lose some of their money. It was the 37th time uninsured depositors lost money in a bank failure since 2007. To sum up, small businesses that banked at Silicon Valley Bank were protected while those that banked at this Oklahoma bank lost money. How is that fair? My bill, H.R. 4551, the Employee Paycheck and Small Business Protection Act, would address this problem with a data-driven approach to expand deposit insurance in a deliberate way, considering the benefits and costs to ensure a higher threshold is set so community banks and credit unions can compete for small business deposits in their communities, and those businesses and their workers are better protected. My bill would also provide for emergency transaction, account guarantee, or tag authority, allowing the FDIC to temporarily insure deposits for up to 9 months without needing congressional approval first. I appreciate that Chairman Hill held a hearing to consider my bill, and we had a good discussion. Are these reasonable reforms that this committee should act on for the benefit of community banks, credit unions, and the communities they serve? Mr. Johnson?
Yes, Congresswoman, those are very reasonable, highly well-informed proposals, and I do think further study, the data-driven approach that you're recommending is exactly the right way to go about it.
Well, thank you very much. We have been in a considerable discussion, and much of the discussion is around how much more should be protected. And I hope we get to some resolution on it because I think it's very important. Let me move on and talk a little bit about bank capital. Professor Johnson, over the course of our nation's history, we've routinely seen banks fail due to capital inadequacy, whether it was the savings and loan crisis of the 1980s and 1990s or the 2008 global financial crisis that cost our economy trillions of dollars and cost millions of families their jobs, homes, and life savings. Moreover, research shows that better capitalized banks lend more, including in times of stress, compared to weak banks that lend less. Would you briefly discuss why strong capital requirements are so important and who suffers when capital levels are reduced too much?
Capital levels are important, Congresswoman, because that's the buffer against losses. And when an individual bank is in trouble and faces potential insolvency, that's what causes a potential bank run. And if those fears are spread across the broader economy, then you have a financial crisis just like the one we experienced in 2008. And that is devastating to small businesses, that's devastating to communities everywhere. The costs of that for economic growth are absolutely enormous. So bank capital is a way that we attempt to reduce those risks. You can't reduce them to zero, but we attempt to reduce the risk of devastating economic collapse.
Well, I want you to know that they tell us that if you require too much capital, we won't have the money to lend to all of the small businesses that need money. Yet, we don't see any real loans going to small businesses. What do you know about that?
Well, I think providing credit to small businesses is tremendously important, and that's why we have the Federal Reserve, and that's why the Federal Reserve sets interest rates and otherwise determines monetary policy, because they're affecting credit conditions. That's their responsibility. I think what we need from the banks is to retain strong community banks, strong credit unions, exactly with the deposit guarantee extension that you're proposing and the tag. And I think that combination will strengthen lending to those communities. If you're just providing support in crisis to too big to fail banks, which is why they have a low cost of debt, that is not helping communities across America.
Well, thank you very much. We had a markup on the floor yesterday, Invest Act, and we're talking about capital formation. At some point in time, we need to talk about the responsibility of the banks instead of looking all over the world for more capital for small banks.
Gentlelady's time has expired. The gentleman from Texas, Mr. Williams, is now recognized.
Thank you, Mr. Chair, and thank all of you for being here today. Good to see my friends. I'm a small business owner in the great state of Texas. I'm a car dealer. And the previous Basel III endgame proposal would have pushed capital standards well beyond what a strong and stable banking system requires. And as chairman of the Small Business Committee here in Congress, I'm concerned that the proposal would limit credit access for small businesses, especially given differing risk weights for loans to public versus non-public firms. So, Ms. Eversole, what changes to the Basel III proposal would ensure equal credit access for small businesses like mine, or of all sizes, and why is this so important to get it right?
Congressman, thank you very much for your question. Look, you've outlined it correctly. We need to update and change the risk weighting because there shouldn't be a thumb on the scale for public companies versus private companies. There is an impact on more capital on the end users. And what we need to do is ensure that we continue to have a strong economy. And you know full well that that starts with small businesses. So we look forward to seeing that proposal. We appreciate the leadership of the Vice Chairman of Supervision at the Fed. And we look forward to getting that right.
99% of the businesses are small right now in America. Mr. Flood, when regulators raise capital requirements, banks are forced to redirect more of their balance sheet toward meeting these requirements instead of supporting new lending. We've been talking about that, and that shift reduces the pool of credit available to small businesses that rely on steady access for financing day-to-day operations and growth. Need to mention payrolls. And even modest increases in required capital can drastically change a bank's lending capacity, tightening credit exactly where it is needed most. So for a small business trying to renew a line of credit or finance equipment, how directly would these higher capital changes translate into fewer dollars available to lend to the main thing we're talking about, Main Street America?
Great question. Just to give you an idea, for the drawn part, just using, again, Basel III Endgame as an example of excessive capital, for the drawn part of your line of capital, the risk weight increases by 10%, again, above and beyond global standards. And oddly, for the undrawn part, it goes from 20 to 50%. So even for the money you're not using, it increases by 30%. So likely your line shrinks or you pay more.
Ms. Tahyar, when government rules and regulations become overly complex, banks must dedicate significant time and effort to compliance rather than serving borrowers and strengthening their businesses. Sometimes keeps you from making a loan. And this can be especially challenging for institutions competing in global markets where other banks may face simpler or more modernized frameworks. And these burdens can affect everything from product development to long-term strategic planning. So my question to you, Ms. Tahyar, does increasing the complexity of a federal framework force U.S. banks to divert resources away from innovation, technology, and customer service? And does, at the end of the day, this reduce their ability to compete internationally?
Yes, sir, it does. In fact, if we look back, there were many wonderful changes that came out of the financial crisis, but the intense internal investment at banks in compliance personnel, risk personnel, at technology to support them, and the same thing happening at the regulators, has massively increased complexity in the system. Makes it harder for Congress to engage in appropriate oversight. And AI may well change these things, but AI is something that we're going to have to look at carefully, and it needs to be controlled. And it is just so hard to get the full weight of the internal bureaucracies that have been created at the banks, which just take away from the main mission. And if I may, one minor, just quick comment. Capital absorbs losses, but it's not liquidity. A deposit run, which I agree AI is going to make riskier, that's not going to be capital absorbing that loss. That's liquidity regulation or deposit insurance. Capital doesn't solve liquidity.
Main Street America, keep it simple, let it grow, employ people, pay taxes. I yield my time back. Thank you.
The gentlewoman from New York, Ms. Velasquez, is now recognized.
Thank you, Mr. Chairman. Mr. Johnson, I heard discussion this morning about affordability. I'm glad to hear this because I never thought that it was a hoax. Can you talk about affordability for working-class families in times of economic stress if the banks fail?
Absolutely, Congresswoman. So I think it's one of the great tragedies, actually, of our generation, the current America, that we went through this massive financial crisis in 2008 that was absolutely devastating to communities. It destroyed businesses. It completely disrupted the housing market. Many of the problems that we're struggling with today in terms of providing goods through competition and at reasonable prices with reasonable supplies are because of that financial crisis. We didn't build 4 million housing units after the crisis, and we've never built them, Congresswoman. We've never caught up. So for ordinary Main Street America, the financial crisis of 2008 was absolutely devastating. And when we say there's a bailout, or bailout was provided, it was let's be very clear, it was a bailout to the creditors, particularly of large banks. The shareholders got a pretty good deal too, but the workers across the economy, the people who run non-financial businesses, the people outside of the financial sector, they were crushed. And they were crushed because our banks took on too much risk. They did not have enough capital. We did not have the kind of protection that Chairwoman Waters was talking about in terms of the deposit insurance, not sufficiently. That combination is absolutely toxic to ordinary Americans, and we see it now reflected exactly in today's affordability crisis.
And we shouldn't forget the lessons of COVID-19. Banks were sitting in trillions of dollars in capital reserve, and yet small businesses were not getting loans. It was Ranking Member Maxine Waters, myself, and Speaker Pelosi, who called the Secretary of the Treasury, and we put a set-aside of $60 billion to be lent to underserved communities. Professor Johnson, you testified before this subcommittee last February. As part of your testimony, you stated, over the business credit cycle, well-capitalized banks are better able to sustain lending than banks with relatively little capital that fund themselves with more debt relative to equity. Can you explain this statement, and what does the research tell us?
Well, the research and the practical experience and what we've seen from around the world over 100 years is that when investors are concerned that a bank is deficient in capital, when they think there's a probability of insolvency, that's what happened with Silicon Bank, there was concern about insolvency, then you get a run, that's again what happened in Silicon Bank, and then the run spreads across other supposedly similar institutions. At the moment, humans make those decisions, but as Dr. Foster said, very soon it's going to be agentic AI making that kind of decision. So then we have concerns about insolvency becoming a system-wide run. If we don't have adequate tools, the authorities do not have adequate tools to respond to that, then you have a major financial crisis, as we saw in 2008. So the best way, Congresswoman, to withstand that, the best way to ensure the kind of national security that the White House is talking about is precisely to have a well-capitalized, resilient banking system to prevent this from happening.
And isn't it true that even after the first part of the Basel III capital regime was implemented in 2016, U.S. banks continued to lend and make record profits while the economy continued to grow?
Absolutely, Congresswoman. I'm looking here at the data provided or compiled by the Kansas City Fed, and we can see that exactly when you're discussing in the mid-2010s, there was a lot less leverage in the big banks than there is today. And by the way, the smaller community banks have maintained less leverage throughout this period than the big banks. That's their choice. That's not what's forced on them by regulation. That's sensible big practice. It's the big banks that have a large implicit guarantee from the U.S. taxpayer. That's what too big to fail means. Their debt is subsidized implicitly by the American taxpayer. That's too big to fail. They, of course, want as much leverage as they can get because their debt is super cheap because of the subsidy that they get from the U.S. government.
Thank you. I yield back.
The gentleman from Tennessee, Mr. Rose, is now recognized for 5 minutes.
Thank you, Chairman Barr and Ranking Member Foster, for holding this important hearing, and thank you to all of our witnesses for taking time to be with us today and lend your expertise. Mr. Olmem, the 2023 Basel III Endgame proposal would have raised capital requirements by 16% on average, with some banks seeing increases over 20%. The proposal received overwhelming criticism and was ultimately withdrawn. As regulators prepare a revised proposal, what are the most important principles they should follow to ensure the final rule appropriately balances risk weighting with the statutory mandate from Congress to tailor requirements based on bank size and risk profile?
Thank you for that question. Well, first of all, making sure that the risk weights are based on the best available data. Capital should correspond to risk. That's the first one. Two is simplicity. Capital requirements have become simply too complex and hard to really understand. I think it makes it difficult, as Meg was referring to. It's hard for the public to understand even what capital requirements are. It makes it very difficult for Congress to evaluate and also banks to comply with. So making them simpler is better. Certainly, many banks are complex institutions, and there's a limits on how much simplicity we can get out of the system. But it's certainly any efforts in that direction are beneficial. I'd also note too that it's really important as we to take a view of the totality of all the regulations that are going on. I think that is one of the things that I think Mr. Johnson misses, is that this is not 2008. And I think back in 2008, I would have shared some of his concerns about capitalization levels, but that is not where we are today. We have, in addition, all the reforms that have happened over the last 15 years, and we need to make sure they all work together. We have stress testing now. We have additional leverage ratios. We have the Volcker rule, risk retention rules, right? We have a 2,000-page Dodd-Frank Act of rules on banks that have substantially changed their risk profiles. And what the regulators are really doing right now is trying to make it all work together in a more efficient way, so that the banking system is certainly safe and sound, but that it's the distortions in credit allocation that are occurring because of the lack of coordination amongst this system are diminished.
Thank you. Mr. Flood, increased capital requirements have already driven banks out of certain business lines. Residential mortgages dropped from 81% bank origination in 2007 to just 39% by 2022. In your testimony, you discuss how the original Basel III Endgame proposal would have particularly affected lines of credit and warehouse lending. Can you explain what happens to credit availability and pricing when capital requirements increase for these specific products?
Absolutely. A couple of things to think about. Again, when we look at Basel III Endgame, which of course in many cases goes above and beyond global standards. With a line of credit, I think I had explained before, the funded part goes from 100 to 110%, and the unfunded goes, risk weighting moves from 20 to 50%. So two things will happen. You either will pay more for your line of credit, or you will have a smaller line of credit, so that when you need more, you'll have to get another and pay more. Two, and again, I'll keep repeating this, a private company, 99%, will pay more than a public company. And my example, again, is if you take a loan to the public company at 7% and you assume a 12% return on equity, the private company is going to pay a 10% loan. It's a significant difference. And then finally, the last one I would say is there is a 10% capital charge on all retail. So put credit cards on the list, put autos on the list, and put mortgages on the list, and they all increase.
Wow. Thank you. Mr. Olmem, you make the point in your testimonies that capital is critically important, but it is not the only option in the regulatory toolkit. You note in your testimony that the banking regulators are undertaking important reforms to the supervisory process. Why is getting supervision right just as important as getting capital requirements right, and how do these work together to promote both safety and soundness and economic growth?
Thank you for that important question. Supervision can spot those risks that aren't on the balance sheet, right? It's the way supervisors can exercise judgment and understand how a bank's management is addressing risks. The only way you can see that is knowing who the bank managers are, understanding their strategies, and working with them to understand how they're managing those risks. I think if you look at any major bank failure, supervision is usually at the core of the problems. Supervision also is an effective and efficient way to make sure that banks are properly regulated without excessive regulation.
Thank you. My time's expired. I yield back.
Gentleman's time's expired. Gentleman from Georgia, Mr. Scott, is now recognized.
Thank you, Mr. Chairman. Ladies and gentlemen, this is a very important hearing, but especially to our farmers. Sectors like agriculture that rely heavily on access to credit, risk management tools, and functioning derivative markets. And so, Ms. Eversole, let me come to you first. Our farmers operate in a world of volatility, from supply chains, disruptions, fluctuating global demands, and extreme weather. There is no other sector of our economy that is as serious in terms of receiving these obstacles. So let me just ask you this. Large banks play a key role in providing risk management for agriculture producers through futures, options, and swaps. Now, if Basel III makes it less attractive for our banks to provide these hedging services, what would be the direct effect on our farmers?
Congressman, thank you very much for the question. I'm also from the great state of Georgia, so I deeply appreciate the concern about farmers here. I mean, the reality is it's going to make it more expensive. And I mean, you know very well how hard it is to manage risk. You know, is there enough rain? How's the, you know, and that all has an impact on the crops. And the ability to manage risk and understand where you're coming out of this. The Basel III Endgame has an impact on that. And it's not just about the farmers, it's about where those products go. They end up on store shelves. It also impacts the price of fuel when you think about biofuels and ethanol. And so we need to get this right, Congressman.
And we have a good audience listening. Do you anticipate certain particular products would become less available to our farmers, particularly customized or longer-term derivatives?
If we don't do this right, that will impact not only the cost, but also the availability. And so we look forward to making sure that we get this proposal right and provide the certainty to America's farmers, especially in the great state of Georgia.
Absolutely, and go Dogs.
Go Dogs. Thank you so much, sir.
Now, excuse me, Cole. Let me turn to you, Mr. Johnson. Do you believe that farmers, businesses face any disadvantages if foreign competitors operating under slightly different capital rules have lower hedging costs?
I think, Congressman, it's very important to study this question and to examine exactly what kinds of market facilities and also subsidies are available to farmers and other competitors in other parts of the world. And sure, if there are unfair forms of competition, those should be looked at, and there are various, as you know, legal and regulatory remedies available under those circumstances. However, Congressman, I do think that having a strong, resilient banking system of our own, including community banks, including credit unions, including those issues focused on farmers, that's incredibly important. And when I look at how much capital those institutions choose to have, they choose to have it. This is not what they're required to have. They have substantially less leverage than the too big to fail banks. So I think that we have some fantastic and very important financial institutions serving those communities, Congressman, and I think we should aim to strengthen them, and they are themselves choosing not to over-leverage, in which I really commend them.
And finally, will U.S. farmers and businesses face any disadvantages from these foreign countries?
Unfair foreign competition is a problem, Congressman, and it needs to be addressed in a careful, well-regulated way, and we have a long tradition of doing that in the United States. I do think, though, that what we have currently, as a result of the reforms after 2008, with regard to strengthening the financial system and lowering the leverage, at least we lowered it until 2016, 2018, I think that was helpful to farmers. Allowing the big banks to become over-leveraged is not helpful to farmers.
Thank you very much.
The gentleman from Georgia's time has expired. I'll just have to say, as the husband of a Georgia Bulldog, even though I'm a Kentucky Wildcat, to you and Ms. Eversole, go Dogs. All right.
Way to go.
The gentlewoman from California, Ms. Kim, is now recognized for 5 minutes.
Thank you, Chairman and Ranking Member, for hosting today's hearing, and I want to thank our witnesses for being here. Thank you. As you may know, I have been keenly focused on modernizing the community bank leverage ratio to uplift our community banks. And according to prudential regulators, around 85% of our community banks qualify for CBLR, yet only 45% of them actually use it. That's why I introduced Community Bank Lift Act that will modernize CBLR to ensure that more community banks in California are focused on consumers rather than regulatory red tape. Mrs. Tahyar, when you look at tailoring, do you agree that there is still more fine-tuning to be done regarding the community bank leverage ratio?
Yes, I think there is. The vice chair and the board have come out with a proposal, as you know, which would take it to 8%, and also importantly would give a longer for-credit grace period. Mm-hmm. And it's not entirely clear to me exactly why only 40% of the community banks could benefit from it, but I think the cliff effect of a 2-quarter grace period, which for a community bank is, way too swift, is part of the concern there. I also think in terms of tailoring, picking up on something that Andrew said, with growth in the economy and inflation, when in a tailored system, that growth and that inflation will simply have banks grow into the next asset threshold when they really shouldn't be there.
Thank you. Today we heard a lot about the leverage of large banks today. So, Mrs. Tahyar, can you explain how low-risk activities like treasury market intermediation are impacted by binding leverage requirements?
So, and this was obviously worse before the recent change in the ESLR, but it's still part of the leverage ratio. The market for treasuries has simply exploded with the increase in the deficit. That means that you have an impact on the market for treasuries because those entities that would have been trading in treasuries, if the leverage ratio becomes binding on them, they're going to stay out of the treasury market. And now we're more dependent on non-banks or on foreign actors in the market for treasuries. Maybe stable coins will eventually make a difference. I know that that is part of the hope, but what we've experienced in some of the kerfuffles in the treasury market is certainly bound up with the fact that the classic players just haven't been playing the way that they used to.
Thank you. You know, as we continue to evaluate tailoring and capital requirements, the impact on small businesses must be kept top of mind. Many small businesses rely on affordable and reliable credit from regulated banks to grow and manage day-to-day operations. However, increased capital requirements, such as those proposed under Basel III and through the GSIB surcharge, can raise the cost of lending and reduce credit availability. So I want to ask you, Mrs. Eversole, Eversole, how are these capital rules impacting small businesses' ability to access credit today, and what adjustments should regulators consider to ensure that credit remains affordable for Main Street without compromising safety and soundness?
Congresswoman, thank you very much for the question. I would note that my member companies have more than $100 billion in outstanding loans to small businesses today. And that's really important because we know that small businesses are the economic engine for growth in this country. The Basel III endgame, as proposed in 2023, would have had inappropriate risk weighting that would have impacted small businesses negatively through the form of higher capital. And I think, as I've mentioned today, higher capital isn't always better, and it comes at a cost. And I think the question about getting this right, making sure that in the proposal we look forward to from the Federal Reserve, hopefully as soon as possible, getting it right really matters, and we want to make sure that America's small businesses are protected, but also can borrow money at a fair cost so they can get to the business of growing their businesses.
Couldn't agree with you more. Thank you. You know, let's shift gears now. In today's era of banking, it appears that the success of your bank will not be dictated by innovation or competitive product offerings, but rather by how you can handle the compliances caused as your financial institution continues to grow. We're almost forced to either defend Dodd-Frank as banks fail around us, or we find ways to tailor regulations to serve the dynamic economic roles that these financial institutions play. I know I'm running out of time, but hopefully you will have time to answer this, Mr. Olmem. Has Dodd-Frank created the accurate, precise regulation that was expected, or has it created more regulation with little or to no benefit?
Mr. Olmem, you're going to have to submit that answer in writing. The gentlewoman's time has expired.
Thank you.
The gentleman from California, Mr. Sherman, is now recognized.
Thank you, Mr. Chairman. I think we all agree. If capital standards are too low, we face the risk of needing bailouts. If they're too high, our economy is smaller than it otherwise would be. But we should also agree that if you discriminate against certain borrowers and help other borrowers, you pick winners and losers. But what's worse is if you pick the wrong winners and the wrong losers. Banking is too important to just focus on the bank. It allocates capital in a society dedicated to capitalism. Now, there's real risk in loaning money to Jack's Pizzeria in Tarzana. And we should state that fairly and have adequate reserves. But we shouldn't understate that risk just because the pizza's delicious. We shouldn't understate that risk just because we love small business. But when we look at Basel III's current configuration, we see a system designed to oppress, to discriminate against small business, new home buyers and all home buyers, and U.S. taxpayers for absolutely irrational reasons, except for the fact that the people in Basel all just feel real comfortable with giant corporations and their long-term bonds. First is to home buyers. First, there's a proposal here to increase the risk weight beyond the Basel levels for all home mortgages. And then, as I've commented before in this room, they ignore private mortgage insurance. So you have a system that discriminates against all home buyers and then doubly discriminates against the first-time home buyers with the low down payment that need the private mortgage insurance. I've heard no defense of this. It's just people jump up and down and say, Basel, Basel, wonderful town. Let's just do what's in the document. Don't read it too carefully. Then we have intentional discrimination against small businesses in two ways. As Mr. Flood points out, if it's a public company, we discriminate in favor of them and against the private company. But second, small businesses don't post an interest rate risk because they tend to have floating rates or short-term loans. The 30-year fixed rate bond is discriminated in favor of because we don't mark to market. Had we done that, we would have realized that Silicon Valley Bank had $17 trillion in unrealized losses. But even after that, we've got a system that discriminates against the small business and in favor of the competing 30-year corporate bond that is not marked to market. Then Ms. Tahyar says we should also discriminate in favor of the crypto billionaire bubble creators. I just say you don't have to be a genius to recognize that crypto assets are very volatile. And then in the area of long-term bonds, we discriminate in favor of the corporate bond and against the treasury bond by treating them both the same, even though the treasury bond doesn't have the risk and the corporate bond does. So we have a system here designed to unfairly discriminate against home buyers, particularly first-time home buyers, small business as opposed to publicly traded big business, and the U.S. government and its taxpayers. Gee, what could go? Well, what's the matter with that? Ms. Eversole, the Basel III endgame proposal for 2023 included higher risk weights for mortgages than recommended by the Basel Committee. As I pointed out, it discriminates in favor of publicly traded companies. How do your banks take capital requirements into consideration or when making a small business loan or a home loan? And would the consequences of this be fewer loans for home buyers and small businesses?
Congressman, you said it very well. The impact is straightforward. It would reduce the amount of loans made, and it would make the ones that are made more expensive. It was a bad, flawed proposal, and we need to see, we look forward to seeing the reproposal that we expect as soon as possible.
Ms. Olmem, we've got a system that pretty much ignores PMI. It does not follow the FHFA Enterprise Regulatory Capital Framework that Fannie and Freddie use. What should the Basel, what should this regulation do with regard to mortgages?
I think the risk weights that were originally put in the original proposal were too high and need to be revised.
Thank you.
Gentleman's time has expired. We're going to just go out of order just for a minute for a parliamentary request from the gentleman from Texas.
Thank you, Mr. Chairman. Mr. Chairman, because I have 3 hearings taking place today, I ask unanimous consent that I be allowed to place questions in the record for the witnesses, and I beg that I be excused to take care of the many things that I have to do.
Without objection.
Thank you very much.
So ordered. The gentleman from Georgia, Mr. Loudermilk, a lot of Georgia Bulldogs here today. The gentleman from Georgia, Mr. Loudermilk, is now recognized for 5 minutes.
Well, thank you, Mr. Chairman, and I appreciate everybody being here today. While all of America is likely not glued to their television watching this hearing, as they may be some other high-profile hearings, nonetheless, the subject matter that we're discussing here is extremely important to all Americans and their livelihood and their financial stability going forward. So for too long, financial regulators have taken one-size-fits-all approach to regulation, applying the same regulatory standards to small and mid-sized institutions as they would to large and well-resourced institutions. While the biggest banks often have the resources to comply with new regulations, small firms and even some mid-sized firms might struggle to meet these same regulatory requirements. So I'm glad to see us focusing on this topic, and I'm proud of the work that this committee and the Trump administration are doing to right-size regulations on financial institutions of all sizes. Ms. Tahyar, I have a bill entitled the Taylor Act, which would require that all future regulations be tailored to the risk profile of the regulated institution. Are there other proposals out there that you believe would provide the right balance between safety and soundness and minimizing harm to community banks?
Yes, I think so. There are a number of challenges that community and smaller banks face, among which is succession planning, because many of them are family-owned, they're private companies, and making kind of M&A applications easier and more certain, I think would be helpful for community banks. We don't want the barbell, but we've got, 4,000 banks and 4,000 credit unions, so some degree of consolidation seems to me to be fruitful. Other elements on tailoring are indexing the tailoring, and then I think the shift that the vice chair has put in place away from process-oriented supervision, which just takes so much. Community bank may have 15 people at the bank. A regional bank is not going to have the hundreds of thousands that a large bank has. So moving away from process checklists just to show things, minutes of meetings that, so that someone can look at them and check whether they did things, I think will focus banks back on what they need to do, and will focus the supervisors on material, financial, and operational risks.
I've had community bankers tell us that what they face is the death of 1,000 cuts.
Yes,
because
sir.
of the requirements. With that in mind, are community banks at a structural disadvantage as compared to large banks who can have teams of compliance specialists when implementing these complex capital frameworks?
They are, and I think that's what the community bank leverage ratio is about, which hasn't been taken up as much as it could be. It's very much a structural disadvantage for smaller banks. To make a mortgage is, the paperwork looks like this.
Right.
And that wasn't the way it was before, but mortgages were what community banks did in the small communities. They knew the people, they could make the mortgages. Now, it's been much, much harder since Dodd-Frank for community banks to make mortgages, and we've seen this flow out of mortgages from the banking sector to the non-banking sector.
It's interesting you bring up mortgages. One of the first bills that I passed after coming on this committee was to exempt institutions that have zero interest mortgages, such as the nonprofits, Habitat for Humanity, to exempt them from this massive regulatory framework just to issue a zero interest mortgage anyhow. In your testimony, you write that any capital framework will need updating and renewal from time to time as markets and technology change. Do you have any thoughts as to how the framework like that should be structured and how often those reviews should occur?
Well, under the regulations, they're supposed to be reviewed every 10 years, and that is very much not honored, and that's for all of the banking regulations. I don't want to front run whatever we're going to see a Basel III proposal from the banking regulators quite soon, I hope. And so I don't want to make suggestions about what should happen in the onward, but what I did want to open folks' minds to is, we call it endgame, but it's not the end of the game. There's been mentions of agentic AI and various other changes, and I just want us to keep in mind that there is no end to game. There's no end to keeping up with what's happening in technology in the market.
Okay. Thank you, Mr. Chairman. I yield back.
Gentleman yields back. The gentleman from Massachusetts, Mr. Lynch, is now recognized for 5 minutes.
Thank you very much, Mr. Chairman. I want to thank the witnesses for your help this morning. Mr. Johnson, earlier Mr. Olmem said correctly, we're not in 2008. However, I was here in 2008 on this committee, and so the reason we're not in 2008 is because of Dodd-Frank. We put in enhanced capital requirements. We put in greater prudential standards. We stopped the banks from engaging in some very risky activity. And now, if you listen to Michelle Bowman, the vice chair of the Fed for supervision, we're seeing a marked change. We're we're moving away from those, the more demanding stress tests that we put in place. We're relaxing, well, there's a recommendation to relax the supplemental leverage ratio. We're not doing, like I said, we're not doing the stress testing. And again, those prudential standards are dropping. So with all of that, let me also add, Vice Chair Bowman also gave a speech in Madrid last month where she said that banks should be able to compete with non-banks in cryptocurrencies and digital assets, which introduces a whole pile of risk into the banking industry. And I think we're all in agreement that, as others have stated, capital requirements should reflect the risk that's being engaged in. So with all of that, aren't we heading back towards 2008?
Well, we're heading back towards a financial crisis of the magnitude or bigger than 2008, absolutely, Congressman. So you're right, the Dodd-Frank helped a great deal, and that's what reduced leverage in the bank system, all of those measures combined. And we can see from the data provided through the Kansas City Fed that leverage was at its lowest point in the mid-2010s. And since then, there's been an erosion, as you say, on multiple fronts. And Vice Chair Bowman seems to be determined, along with the other regulators, the FDIC and the OCC, to allow more leverage. At the same time, the world around our financial system has become a lot more dangerous. Financial panics repeatedly, including the Silicon Valley Bank, a pandemic, the rise of China, absolutely transformative, the arrival of AI, and of course, you're right to emphasize crypto. Whatever you think about the future of crypto, whether it's bright or not, it's certainly highly volatile. And if the regulators are allowing the banks to become more intertwined, either directly with a cryptocurrency or with an entity that is itself speculating on cryptocurrencies, then that's a lot more risk. The only way to handle risk from a financial system stability point of view is to have more capital. The banks don't want to do it, Congressman, because they have these massive subsidies, the too big to fail subsidies. They love the leverage. Bank executives for the big banks get paid on the basis of return on equity unadjusted for risk. So they want to load up on risk. They don't want to care about capital. They want to shove the costs onto the taxpayer. They get the upside. The taxpayer and regular Americans get the downside. So that's 2008 again.
Yeah, let me ask you about, there's much faith being put on AI, but from this committee's perspective, we're seeing a small handful of AI firms that are really going to dominate. And so their products will be used by hundreds, maybe thousands of banks. So they're all going to be operating off the same recommendations, the same algorithms. Doesn't that create a concentration risk if multiple banks, perhaps hundreds of banks, are actually making decisions based on the same recommendations?
Yes, and we'll see concentration risk exactly there, where banks make decisions, but also what Dr. Foster was talking about, which was agentic AI on the part of investors. So investors will be coming into assets and leaving assets really very fast. They'll be interacting with other AI. They'll be gaming the system. This is all volatility, Congressman, and the only way to ensure the system against volatility is with more capital, not less.
Right. So with all these added elements, especially with the crypto piece of this, and the president, certainly the White House is inducing banks to get more involved with crypto, wouldn't it make sense to increase the capital requirements for those firms that are engaging in crypto activities?
Yes, absolutely. Crypto is dangerous. And I would point out that the leverage is going down in community banks and regional banks. It's the too big to fail banks that are leveraging up, and they're the ones that want to pile into crypto. It makes no sense. It's super dangerous.
Thank you, Mr. Chairman. I yield back.
Gentleman yields back. The gentleman from Nebraska, the other Mr. Flood, is recognized for 5 minutes.
Thank you, Mr. Chairman. And to our stenographer, the record should reflect that I do represent the people of Nebraska. The other Mike Flood, though, is welcome to do all my town halls next year in Lincoln. I will afford you that opportunity. With that, Mr. Eversole and Mr. Flood, as chairman of the Subcommittee on Housing and Insurance, I'm concerned that over-calibrated capital requirements are limiting consumers' access to affordable and reliable mortgages. What reforms should we consider to ensure that consumers continue to access safe, reliable products and services such as mortgages?
Thanks very much for the question. I think it's important to note, as we have reflected on changes since 2008. In 2008, only 20% of mortgages were made outside of the banking system, and today more than 60% are made outside of the banking system. And when we think about risk, we know that America has a highly regulated, safe, sound banking system. And when we're pushing things outside of the banking system, we should ask the question, is this because of regulatory arbitrage, or is this because of a good, sound, competitive marketplace? I think that's point one. Point two is it's time to see a Basel III endgame proposal that gets this right, because the costs to first-time home buyers, to small businesses, we should not be placing inappropriate risk weighting on that, and so we look forward to the new proposal.
Mr. Flood?
I just add a couple comments. Clearly agree with Ms. Eversole on making sure that the risk matches the product. But one thing that I would point out as you consider affordability, when we look at Basel, a lot of times it will treat, especially on the commercial side, a privately done affordable deal with no backing differently than one that's supported by the GSEs. And I get the concept, but if we're going as you well know, if we need all hands in the boat on affordability, that's definitely an area that should be looked at, and clearly the risk weights for residential mortgages as well.
To Ms. Eversole's point, like, we have this fantastic banking system. It's diverse. It's better than anything Europe has. We have federal banks, state banks, community banks, regionals, GSIBs, but what kind of connection will they have to Main Street if, like you say, 60% of this is done? And we're going to be talking about GSE reform sometime in this Congress. Is it a capital requirements issue? Like Mrs. Tahyar, like, is it a capital requirements issue? Can we make changes so that banks are more incentivized to get in the mortgage business? Because I think they're going to lose their link to Main Street if they don't have that relationship with the consumer.
I strongly agree with that, and I think it's more than a capital requirement. I mean, what small banks have to do a mortgage loan to somebody in their community who they've known for 30 years, since Dodd-Frank has become enormously complex. Obviously, there were problems in the financial crisis with the liar's loans and not checking income. But what we've done basically is we've made it too hard for community banks to do what was done for my aunt 30 years ago, which is she was in the State Department, she was stationed in a foreign country, she needed to have a home equity loan, and the guy from the community bank, from the mortgage she'd already paid off, walked down to the house, walked around the house, came back, and told her what he could give her. I don't think that would happen today.
Right.
Mr. Flood, if I may, I think there are three concrete things that should be looked at in the Basel rules. One, mortgage servicing rights. Servicing, yes. While the Chamber has absolutely no bias towards who wins in competition between banks and non-banks, a level playing field is important. And I think we've seen the migration of servicing out of banks into non-banks, and I think the reason is entirely for capital reasons. So we should think about whether we are biasing one form towards another. Another would be warehouse lines. We should look at that. And finally, of course, the risk weights around mortgages themselves.
Very good. I'll finish up here quickly, but Mr. Olmem and Mrs. Tahyar, do you think that the complexity of bank capital requirements can drive further bank consolidation? I mean, I have banks in my district, in the largest city, that are afraid to grow because they're bumping up against, a new assessment that's going to be painful. You don't want that. When that happens, they'll be more likely to say, oh, we'll sell to a big regional. What do you think?
It's the cliff effect of thresholds which have created that adverse incentive, and it's certainly something that the current supervisors are looking at.
Yeah, I fully agree. I think this is one of the key issues at stake with these reforms, is whether or not we are going to be able to have regional banks in the United States going forward.
We need them and want them, and with that, I'll yield back.
Gentleman yields. The gentleman from North Carolina, Mr. Moore, is now recognized.
Thank you, Mr. Chairman. During the last administration, banking regulators drifted away from their core statutory mission of protecting safety and soundness towards subjective judgments of political priorities. That shift has created uncertainty and imposed disproportionate burdens on the community and mid-sized institutions that drive credit formation. Now we finally have an opportunity to restore some regulatory discipline and return to a framework where requirements are truly risk-based and proportional. We're working to revive this principle of regulatory tailoring because the requirements should match an institution's actual risk profile, as several of the witnesses have already testified to. Ms. Tahyar, we have emphasized the need to strengthen tailoring, especially across categories 2, 3, and 4 banks. What specific changes to capital and liquidity requirements should be made to ensure mid-size and regional banks are not subjected to requirements that simply don't match their actual risk?
So I think, you've got in the tailoring statute, you've got $100 billion, but there are other numbers that are not in the statute, and I think they should all be revisited. There is a proposed TLAC proposal that's out there that would calibrate a long-term debt requirement for mid-sized banks really as high as what the GSIBs have, and I think there should be data-driven thinking to bring that calibration of TLAC down. And then I think there should be, in the same way as the community bank leverage ratio, there should, a bank that hits $100 billion has to start its large bank program when it's at $75, $80 billion. And then there's this enormous kind of process checklist kind of thing. And I think the more efficient supervision and more transition periods as thresholds are met, as well as the indexing of thresholds, would all be wise.
Thank you. Charlotte, that's in my district, is home to some of the most strategically important banks in our country. These institutions don't just compete domestically, but also with major foreign institutions subject to very different regulatory schemes. So, Ms. Eversole, how do U.S. capital proposals compare internationally, and what risks do you see if the United States ends up materially higher with its requirements than our global peers?
Thank you very much for the question, Congressman. Just for the 8 largest banks, one of which is headquartered in Charlotte, we pay we owe twice the capital as a consequence of the GSIB surcharge in using Method 2 versus our international counterparts applying Method 1. And it really doesn't have to be that way. That doesn't drive additional safety and soundness to the system. And so it is in all of our interest to ensure that that we have the safest, most liquid, most vibrant capital markets, and we serve our customers in the very best possible way. But gold plating just simply doesn't make sense, and we should revisit that.
Thank you. We need to get back to a capital framework that supports growth and competition both at home and abroad. So I'll go to Mr. Olmem. Currently, only about 40% of eligible community banks opt into the community bank leverage ratio. How should the CBLR be reformed so that it truly reduces burden and can be used by qualifying banks?
Thank you for that question. The current proposal that has been out to revise the community bank leverage ratio, I think, is a good step in the right direction. It will lower the overall leverage ratio to 8%, but also it will allow exempt institutions from having to still calculate the risk base as well, which is pretty expensive. And oftentimes institutions, if they have to calculate it, they'll just go ahead and comply because a lot of the compliance costs are there. Removing that requirement also should help take up. So I'm hopeful that the existing proposal should improve the take-up rate.
When the Biden administration released the original Basel III Endgame proposal, they received an overwhelming number of critical comments. One analysis found that 97% of commenters opposed the proposal, and more than 85% came from outside the banking industry, including farmers, small businesses, housing advocates, and manufacturers, all citing concerns about higher costs for goods, services, and lending that, of course, we've seen impact the economy. So, Ms. Eversole, what are the impacts of increased bank capital requirements beyond just the balance sheets?
Right. At the end of the day, there are consequences to more capital. It doesn't come for free. And the consequences, as you articulate them from the prior proposal on the Basel III Endgame, would have had a disproportionate impact on privately held companies like small businesses across America, America's farmers, America's savers, America's retirees. We need to get the proposal right, and we look forward to the proposal that's coming out.
So regulators had determined that capital levels were about right in 2020. What changed?
I'm going to have to ask you to respond for the record because
I believe we're out of time. Thank you, Mr. Chairman. Appreciate it.
Thank you, Mr. Chairman, and I want to thank all of our witnesses for their testimony today, and I request unanimous consent to enter into the record an op-ed that I authored in support of H.R. 1761, legislation notice for this hearing, that I'm leading with Representative Wilson of South Carolina, celebrating the 250th anniversary of our republic. cited as the Donald J. Trump $250 Bill Act that directs the Secretary of Treasury to print Federal Reserve notes in the denomination of $250 featuring a portrait of Donald J. Trump. Without objection, all members will have 5 legislative days to submit additional written questions for the witness to the chair. The questions will be forwarded to the witnesses for the response. Witnesses, please respond no later than January 15th, 2026. This hearing is adjourned.